It's easy to make money if you just start with money. Just invest $10 million in the S&P 500 and sit back and relax with your steady $400,000 a year income. Or, just take a small $1 million loan from your father and start a business. Easy as that. For everyone else, it's much harder to get started. More than 7 million Americans don't even have a bank account. A record number of Americans can't even afford rent. And 1 in 4 Americans struggle to afford food. Dave Ramsey says that 78% of Americans are living paycheck to paycheck. Americans say they need $500,000 in savings to feel financially secure. And this is a survey from 2021, so that would be more like $582,000 today. Fortunately though, there's a solution to build your wealth from absolutely nothing. And it doesn't involve some BS cookie cutter advice from every article or finance YouTuber like,
just stop buying Starbucks coffee and just save 15% of your income and put it in your 401k and
just don't be poor.
Sure, some of this is probably actually good advice, and it's probably better than what most people are doing, but saving $8 a day on a cup of coffee isn't going to make you a millionaire anytime soon. But as far as realistically building your wealth while starting from nothing, regardless of your education or even your background, these are my recommendations that I've learned firsthand. There's certainly some step-by-step instructions that anyone can follow, and all it costs you is 1 like and a subscribe, because this helps tell YouTube that my videos aren't complete trash, so I can push them to broader audiences and help me grow my channel. Thank you so much, and let's get started. First and foremost, be careful who you listen to. There are a ton of people who are dead broke, but giving financial advice all over the internet. Now these are usually the people who tell you not to get any credit cards or any loans because all debt is bad and that you shouldn't start a business because it's way too risky. Usually this type of person has really good intentions and they probably even believe it themselves. And maybe they watch too much Dave Ramsey. But the fact of the matter is, you should surround yourself with people who are successful and only take advice from people who are themselves into good financial situation and who are where you want to be. As much as I think he's an idiot, Grant Cardone's advice is probably better than your Uncle Jimmy who wiped out his emergency fund trading stock options on Wall Street bets. Next, unfortunately this is true, but you do need some money to make money. So if you want to get wealthy, starting with absolutely nothing, you need to go and make some money and start planting the seeds. If your goal is to make as much money as absolutely humanly possible, you probably aren't going to do that with just a job. Unless you manage to become like a hedge fund manager or Steve Ballmer or something. That being said, you will need a job to get that snowball rolling. Ideally, you pick something that has a very high ceiling with a lot of room for growth that also has reasonable hours, so you have time outside of work for a side hustle, to start a business, or to deal with other additional income streams like real estate. Now, if you don't have a college degree, a trade job might be an excellent choice. There's a very high earning potential, and once you master your trade, you can start your own business in that trade. The Wall Street Journal said that America's new millionaire class are plumbers and HVAC entrepreneurs. Now, with a degree job, you can get a job in tech or finance, although at big banks, they'll kind of work you to death, so you won't have any extra free time to earn money on the side, so you'll really be relying on your investing. Another great idea, if you're extroverted, is to get a commission-based sales job, where your pay is not directly linked to the number of hours you work, but rather the amount of value you provide. People often say that everything in life is just sales, so it can teach you some great skills that can help you with your next endeavors or starting a business. Something else to consider is that employees who stay at their company longer than 2 years make 50% less. So you can't be afraid to switch careers or do a little bit of job hopping to leverage your skills and make more money. Now definitely be smart about this. Right now is probably not the best time to job hop with companies doing layoffs left to right, but it could be a good time to really sharpen your skills and be ready when the market recovers. Now, the vast majority of people who went from rags to riches started a business. They saw a void in the market and they filled it. They solved the problem, or they even saw an existing business and found a more efficient way to do it. You also don't really need any money to learn how to start a business, as all this information is already on YouTube at your disposal for free. You don't need to spend an egregious amount of money on a course or something. You can find just about anything you need on here for free. Next, you need to build the habit of investing as much of your extra income as you can afford as soon as you get it, whether that be in your business, in a brokerage account, or even in a retirement account. And this is even easier if your broker allows you to schedule recurring payments. Like every other week, as soon as you get your paycheck, you buy more ETFs, or you continue to grow your side hustle or your company. Even if you're saving up to buy a rental property, your down payment will be growing faster in the S&P 500 than it would be in a savings account. As a financial YouTuber, I'm obliged to warn you that nearly 2/3 of millennials spend $7 a day on coffee. If you were to instead invest that money from the age of 22 until the retirement age of 67 in something like the S&P 500 ETF like VLO or SPY, earning an inflation-adjusted 8%, that money would grow to over $1 million, which is actually insane when you think about it. Drinking Starbucks every day for your whole working life takes $1 million of opportunity costs away from you. When you start to think like that, you'll probably spend a lot less money on simple pleasures in lieu of long-term investment growth. When you start off, it's really less about how much money you're able to save and invest, and more about how well you're able to maintain those habits as you start to make more and more money. It's way too easy for people to suffer from lifestyle inflation as they get those raises and don't increase their investments. If you invest $1 at the age of 20 with an 8% return, that dollar will be worth $32 by the time you're 65. If you wait until you're 30 to invest, it will be worth $15 to $65. If you wait until you're 40 to invest, that dollar will only grow to $7. Your investment is worth twice as much if you invest it now than it would be in 10 years' time. This concept really puts it into perspective for me, that it's important to start investing as early as you can, even if you can't invest large amounts, as it really goes a long way over time. One great way is to start by opening a Roth IRA, which is a retirement account that you put post-tax money into. And then when you turn 59 and a half, you're able to start withdrawing that money. And you won't have to pay taxes on any of your earnings. The contribution limit is currently $7,000, or it's $8,000 if you're over the age of 50. So definitely max this out if you can. If you put your $7 daily Starbucks fund into the S&P 500, the $900,000 in interest you earn will be tax-free. If you're starting from the ground up, this is especially beneficial for you for two main reasons. One, if you're investing early, your investment has more time to grow, which makes all the difference. And two, you're probably in a lower tax bracket, so you won't be paying a ton of taxes on the money that you're putting in there, which then can grow tax-free. The next question you probably have is, how much money should I invest? Many financial experts say anywhere from 10 to 15% of your income, but honestly, this probably isn't enough. If you really want to get wealthy, the real number is probably as much as you possibly can. At a 10% savings rate, it'll take you 51 years to retire. This goes down to 43 years at 15%. The more you invest, the better it gets. If you're able to invest 30% of your income, it'll only take 28 years to retire. And if you're really able to live below your means and invest something crazy like 50% of your income, it'll only take 17 years to retire. This is why you really just need to get started and invest as much as you can. And as you make more money over time, keep ramping up the percentage you invest. It's also very important to try to come up with more than one income stream. According to Tom Corley, who has made a study of wealthy people and their habits, most self-made millionaires created their wealth through multiple income sources. 3 income sources seems to be the magic number. 65% of them had 3 income streams. 45% had 4, and 29% had 5 or more income streams. The first income source was usually income earned from a job, just day-to-day job. This is very important because the day job is how you earn extra money to invest in your other income streams. The next source was dividend stocks. If this is something you want to do, it's very simple. You can open a brokerage account with any of the free major stockbrokers like TD Ameritrade or Robinhood, and then you link your bank account, transfer some money over, and buy some dividend stocks or leading dividend ETFs. It's not any more difficult than opening a bank account. For more information on what dividend stocks to buy and how much you'll have to invest to make a living off dividend stocks, you can check out my recent videos on how much money you need to live off dividend stocks after this video. Third would be capital gains, or the value you accrue by holding stocks or other assets as they go up in value. If you buy a stock for $10 and hold it until it's worth $15 and then sell it, you'll have made $5 in capital gains. Now, capital gains are taxed at a lower tax rate than ordinary income, due to the risk involved with investing. You'll pay nothing on your capital gains if your total taxable income is $47,000 or less, if you're single, or $94,000 for a married household. This jumps to 15% for incomes between $47,000 and $518,000 for single and $94,000 and $583,000 for married households, and 20% over everything over $518,000 if you're single, or $583,000 for married households. Fourth, we have interest income. This would be interest that is earned on money that is held in high-yield savings accounts, money markets, or pretty much any type of bank accounts these days may pay out a monthly or even annual interest payments for keeping your money in that account. Fifth, once you have enough extra capital, will be rental income. This one can be a bit trickier than the others, as you'll have to buy at the time when the housing market is reasonably priced and interest rates are reasonably low to make an income. Unlike stocks, where you can kind of just set and forget, with a rental, there are always consistent recurring costs like maintenance, insurance, and taxes. And if you have a loan, you'll need to factor that in as well. You also have to deal with vacancies. So even if your numbers work out, there will be periods where you aren't making any income. You're actually losing money. Now, if your timing is good and you buy in a growing market and get a good deal that cash flows, then you get a 2-for-1 here, as you'll be earning recurring income in the form of cash flow while also earning unrealized capital gains as the property appreciates. This can be even further exaggerated if you are able to find a wedge deal, where you buy a fixer-upper, put some money into it, but increase the value substantially more than the amount of money you put into it. This will give you sweat equity in the property, and it'll also allow you to raise the rents higher, increasing your cash-on-cash returns. You can even take this rental income and reinvest the extra money into the stock market. Additionally, there are a ton of tax advantages that come with real estate. You can depreciate a rental property for 27.5 years, so you basically pay no taxes on your income. Once you had a property for a while and you want to trade up for something more expensive, or maybe you have some multiple single-family homes and you want to exchange them for a multifamily or maybe even an apartment building, you can do a 1031 exchange and basically roll the equity from the sales of all those rental properties into the next project without paying any taxes. And this also resets the 27.5-year depreciation, as you'll have no depreciation taken out on your new property. It starts at 0. Now, if you ever did want to completely cash out of your real estate, you would have to go ahead and pay those capital gains that you've been deferring on your profits. But you will have been earning completely tax-free rental income the entire time you own the properties. And many people will just hold the rental properties for the rest of their life. Andrew Carnegie once said that 90% of millionaires became so by investing in real estate. I haven't been able to find anything to back up this statistic, but there is anecdotal evidence that a large percentage of millionaires do in fact own real estate. Number 6 is any income earned through a second job or a side hustle. Building a second income source, aside from your main day-to-day job, is not only an excellent way to make more money that you can invest and grow wealth with, but it's a great way to diversify in case you ever lose your main job. Additionally, if everything works out, you could eventually start earning more and more from your side hustle than your day job, and then you could just go ahead and run that business full time. Most people have at least 4 to 6 hours a day of free time where they aren't working, so especially if you're young and don't have kids yet, this might be a great time to really grind on nights and weekends to give yourself that edge and get ahead. All right, so what does it take to reach that $582,000 to feel financially secure? I'm just going to assume that anyone watching this video is more ambitious than the average person, so let's set our goal at saving $600,000. Assuming you're starting from absolutely nothing, we'll build up a goal to reach that. According to the U.S. Bureau of Labor Statistics, the BLS, American workers made a median wage of $1,139 a week in the first quarter of 2024, which would add up to $59,228 a year. So for this example, let's say you make at least $60,000 a year. If you make less than that, you can make a plan and keep building up your base and upskilling to make more money. Now, if you make at least the median, let's keep going. The first step is probably pretty obvious, but it's to minimize your expenses as much as realistically possible. Based on a recent poll from Vox, the average American spends a whopping $10,000 a year on non-essentials. Your biggest expense is probably housing, so if you're still young, you can live with your parents longer or get a roommate. Maybe you can move to a cheaper area and drive a little bit further to work. Instead of eating out, you can cook at home. And make sure you drive a reliable and affordable car like a Toyota Camry or Honda Civic instead of some overpriced German luxury car that's going to lose 30% of its value the second you buy it and cost $4,000 a year on maintenance. Generally only spend money on things that you absolutely need. If you've done all of that, I'll assume you have at least $250 per month left over. Next, you can put this straight into a total market or S&P 500 ETF like VOO, the Vanguard S&P 500 ETF, in a Roth IRA. You can then earn around 8% per year, inflation adjusted, tax-free, while even earning a small dividend. Fourth, consider switching jobs, whether it be to a new employer or a new industry altogether. Like I mentioned earlier, workers who switch jobs make substantially more money. Most companies don't even give large enough annual raises to keep up with inflation. So unless you're getting promoted every year or two, you'll likely make substantially more money by switching jobs. This is by far the easiest way to get a 10% pay raise, and most importantly, you can make this extra income without working more hours. If you're able to increase your $60,000 career by 10%, that's an extra $6,000 a year, which is around $400 a month after taxes. Fifth, find a side hustle or even overtime. You can pick up shifts as a waiter, hang Christmas lights, detail cars, or really anything that can earn some extra income. Even if you can only make an extra, let's say $40 a day for 4 days a week, that'll add up to an extra $640 a month that you can invest to max out your Roth IRA and start investing the extra money into a brokerage account. Now, if we add all these up, we'll have saved $1,290 per month. If you invest this into the S&P 500, you'll reach your inflation-adjusted $600,000 goal in just 18 years. After 30 years, you'll have over $1.8 million, which is basically your retirement fund. And this is assuming you don't continue to increase your income over time. Assuming you kept job hopping every 2 years, in just 4 more years, you're making $80,000 a year, which gives you an additional about $750 a month after taxes. If you invest this as well, your total investments will be around $2,000 a month. Adding this to the money that you grew in the first 4 years, it would only take 11 and a half more years to reach the $60,000 target, which means it only took 15 and a half years total to reach your target. As you can see, if you're able to keep earning more money to invest, the snowball will get bigger and faster. If you're able to increase your side hustle income, you can take these numbers down to 10 years or even less. You also need to be really careful about lifestyle inflation, as it will easily foil this entire plan. This is what happens when you go from $60,000 a year to $80,000 a year, and instead of investing your new additional income, you upgrade to a slightly nicer apartment. Maybe it only costs an extra $200 a month, and you earned it. You buy a nicer car, because that darned Camry just didn't have the heated seats you want, and maybe it kind of hurt your back a little bit. You're starting to go out to eat just one extra night per week, but it's just one night, you know? And you start buying nicer clothes, because you need to look sharp for your new job. A few years later, you get a fancy new 6-figure job earning $100,000 a year. Now you can finally afford that house, so you ditch your apartment. Everyone in the neighborhood has a nice BMW or Mercedes, so you have to upgrade your car too. They also have memberships to the local country club. So of course you can't skip that or you're going to totally be left out. What are you going to do? Then you get a huge promotion. You're making $160,000 per year, but you have to move to a higher cost of living area and relocate. Of course, you have to maintain that same lifestyle as before. You could never move to a smaller house, so you need to spend extra money to get the equivalent house in that new area, even though it's more expensive. You'll also need a nicer car to really fit in with all those high-rolling executives. Now that you're making 2.7 times more than you did when you started, but you aren't saving any more money or investing any more money than you did before. That's lifestyle inflation. It's very easy to make pay increases completely disappear. And this can happen no matter how much money you make. You can never out-earn a bad spending problem. There are countless stories of people with super high 6-figure incomes, like Dr. Couples, earning $600,000 per year, living paycheck to paycheck, because they spend $18,000 a month on their house, $2,000 a month on their cars, take countless expensive trips every year. A recent survey found that 1/3 of Americans earning $50,000 to $80,000 a year is living paycheck to paycheck. And somehow 36% of people making $80,000 to $100,000 a year are earning paycheck to paycheck. And 24% of people earning six figures are living paycheck to paycheck. I don't even have to look at their expenses to tell you that this is probably due to lifestyle inflation. Especially for the middle group, who is making more than the lower group, and yet somehow even a higher percentage of them are living paycheck to paycheck. Like, the math don't math. This is a classic keeping up with the Joneses, or I guess these days it's keeping up with the Kardashians? The moral of the story here is that you need to be extremely careful not to spend more money as you make more money. Now, if you need to increase your spending for something like your health because you're currently living off ramen, and you need to stick to a budget. And set a fixed percentage of income that you're going to invest and stick to it. So if that's 25% and your income goes up, although you're now buying chicken and rice instead of ramen, your investments are going to go up as well. And then maybe you can even increase that percentage over time once you reach a healthy, stable balance. You can also just be a complete masochist and spend all of your waking hours working and don't sleep, so you don't have any time to waste your money. Now, everything we talked about today is certainly easier said than done, and will require a lot of pain in the short term, but it's 100% possible. So if you're hungry and you want to make a change for yourself, instead of making excuses and blaming your lack of success on privilege or politics, then you can totally do it. And you'll be so much better off for it. I believe in you. With that being said, thank you so much for watching. If you enjoyed this video, please give it a like, subscribe, so I can keep providing free content for you. Thank you so much, and I'll see you next time.